Hi, I'm Eric.
And I'm Dick. We're the Annuity guys. Eric, we need to talk to folks about whether they should wait on these rates going up or not.
Wait? You mean they're going to go lower? They couldn't possibly go lower, can they? I mean, look how low they...
Well,
could they be under the table?
Well, I think the banks could actually start charging people to take care of their money.
I'm going to pay you a bonus for taking the money and leaving it here. Well, that would actually work.
Nothing is surprising these days. Yeah. But one thing that we do know is that these rates, we were on our videos back in 2011 or 2012.
Back before the gray beard.
We were talking about 2013. We may have to wait till 2013 or late in 2013 before these rates started to go up.
That's right.
And the last Fed chair,
Uncle Ben Bernanke
said that we're going to wait till it gets to 6.5.
Oh, the unemployment.
And then, the unemployment. And then we're going to start letting these rates go up. But now it's at 6.6.
Aunt Janet said no.
And she is giving all of the hints that our economy isn't where it needs to be. And they're going to take their focus off of the unemployment now and get it more on other factors. And I just wonder how long this can really go on.
Well, there's to infinity and beyond, to quote Buzz Lightyear. but the problem with these rates is they keep on pulling it out and pulling it out. And I in the article we're kind of looking at today, I've heard now, well, we'll wait till unemployment is 5.5, or we'll look at the other indicators, or you get the feeling somebody's just saying in the background, we need to keep the stock market propped up artificially until, I'm out of office.
And one of the big things that I know they look at, and that is that our economy is built to run on inflation.
Yeah.
And folks, if we don't have a certain level of inflation and our gross domestic product is too low, then the answer to that has always been low interest rates. And Eric, we were just talking.
Yeah. Well, I think the low interest rate environment has almost forced dollars into the market. I mean,
it does. It's a bubble. It's a bubble that's building in the market.
When safe money is not paying anything, they're forcing you to take risk almost, and so you're forcing the dollars into.
But not everybody wants to take risk, and that's the problem, because it's really penalizing the retirees, the pre-retirees, those folks that are smart enough to know that some of their money has to stay safe.
Right. So when we start looking at safe money, or when we start looking at traditional banking alternatives now, so the market is one. You can go out there, try to get dividends, but you're at risk. Mm-hmm. And we know, as much as the Fed is trying to prop up the market, there's always a chance the correction is going to come. And if that correction comes, then your principal has gone the other
direction. Right, you're caught in that. So when we look at these rates, now one thing that we have seen, the bank rates are very low. The annuity rates have held up way better than the bank rates, and yet they're lower than what we'd like to see. I mean, we'd love to see them higher. But one thing that we've seen is things that 2 or 3 years ago were very, very good at that time, that folks were saying, hey, I think I'm going to wait and see if it gets better.
I can still distinctly recall to this day, 4 years ago, I had a 4.75% guaranteed rate. And the guy just said, 5 years, 4.7, I need 5%. I'm going to wait.
For that quarter of a percent.
You call me back when it hits 5%. I haven't called him back because it's gone the other way. Now I'm saying the good rate at 5 years, 3%. And I still have people telling me, no, I need 3.5 or I need 4. Everybody always wants that little bit more.
And then a lot of folks, they're really needing income.
Yes.
And when you're really needing income and you're needing it at a certain point in time, there's a different way that you really want to be looking at things, and it isn't always about the highest interest rate. No. It's about the highest cash flow, the highest income.
I know. I always get the attribution incorrect, but it's not the return on your money. It's the return
of your money.
And the greater the return of your money, the higher the amount you're getting back. And if that's for life,
correct.
And that's where the strength of the annuity is.
And right now, the contractual guarantees on annuities are really pretty good. I mean, they're very good compared to what's happened to other financial instruments and that type of thing in the safe money arena. So I believe that it is very possible that folks will look back at the opportunities that they've had, that they could have contractually guaranteed certain things about their retirement, or at least a portion of their money. And if these interest rates don't pick up over the next couple of years, 2-3 years, these contractual guarantees can become a lot less, because even the annuity companies have to be realistic that if things don't come back, they have to start cutting back.
Yes, and that's true. Now, I will tell you that this year, in the last 6 months, 8 months, it's probably been one of the most exciting times for me as far as the indexed annuity world, because what I really appreciate about the innovation that's come out is you have more and more annuity companies giving uncapped market participation in a fixed index annuity,
and some of them are including dividends.
Yeah, and that's including dividends, proprietary indexes that give you a little bit more of the word uncapped for me is just so exciting when it comes to annuities, because the opportunity for people to participate in something that they realize they're getting the most of, if the market or the index goes up,
they get
almost all of it, or there may be a sliver or spread that they don't.
Right.
But that in today's rate environment, where you're looking for alternatives, and you know that we're being pushed towards the market, wouldn't it be better to get some of that market participation, and then know that your worst case scenario is you're not going to go backwards?
Correct.
So from an annuity side perspective, when you're looking for alternatives to the abysmal rates that you're getting from the banks, there are some really cool, innovative products out there.
Good options. And then when you add to that the income guarantees that can be attached to that,
exactly,
you've covered both sides of the fence. So you've got really good potential without going backwards, with guarantees against going backwards, but you've also got some contractual guarantees for that future income.
So what's better than your cake and eat it too?
Yeah. Well, and we talk about that a lot.
Yes.
And it gets down to meeting your retirement objectives.
Exactly.
And I think that's the key. Should you wait for higher interest rates? Probably the answer to that, each person has to answer it themselves, but probably not. I mean, you have to look at the present value of your money and realize that it has a future value if you position it properly, and to just sit around and wait, at least on the portion of your money that can achieve your retirement goals today. A sure thing is, what do they say, a bird in the hand is worth two in the bush?
So if you're looking to get out of the bushes, check out the annuities today.
Thank you.